Hey, Brent.
Samantha, hello. How are you doing?
I'm good.
I'm super excited to talk to you. We did a fantastic interview. It was over a year ago now, which is kind of shocking to me. But before we get started, why don't you give everyone a little bio on yourself and let us know who Samantha LaDuc is?
All right. Well, thank you for the invite. I think it's fabulous. And yeah, we did have a webinar. I think it was right before the August swoon. So this is a good time to freshen up. I'm Samantha LaDuc, founder of LaDucTrading.com, and I'm a macro to micro strategist. I also run a live trading room for those who are active traders, not just active investors. And we use a macro backdrop to also identify with lots and lots of money flow options as well for lots of tactical trades and sector rotation, as well as some calls on volatility. I share those insights with clients from retail to institutional, and can be found at LaDucTrading.com.
That's awesome. And what I love most about talking to you is you make your views very clear and concise. No beating around the bush. We know how you stand, and that's awesome. You back it with data and years of experience and everything. And so I really have enjoyed our conversations and your Twitter feed as well. So for this conversation, we're going to do an interview. Do you want to share some screens, a little bit of both? What would you prefer to do?
A little bit of both is
Okay.
fine. We'll just where it goes. I
Excellent.
will give you my rundown, and if you prompt some questions, I'll bring up some screens.
Okay, fantastic. So we are obviously, as we've talked to some of the macro strategists, a couple of traders that we've spoken to so far this morning. Obviously, we have the Treasury announcement yesterday, fall Treasury announcement tomorrow. We have the big FOMC day. And your sort of stance, if I read this correctly, is that we're in a topping phase, I'll call it.
Mhm.
You are trying to target out a top here. So as we head into this, is this the critical kind of pivot point? Do we need to have things play out a little bit more before we possibly pivot and have confirmed a top? Why don't you kind of lay out where you think we stand and what you think we see over the next couple of days here?
All right. Well, the days, it depends on the time frame, right?
Yep.
So, when we actually spoke right before the August 1st QRA, I was very bearish, right?
Mm,
I was stalking a market top,
mm,
and obviously it's not the top. It just means equity correction. So that did come to fruition, right? We pulled back August,
indeed.
September, October low of about 4,100. I was shooting more for 4,000. It's not a game of perfect. Then November 1st, we got the Fed pause and what I call affectionately the Yellen Yahtzee, where instead of issuing more longer duration notes and bonds to fund this growing fiscal deficit, on November 1st, she issued the shorter duration, bills, which is basically liquidity infusing. So we actually get not only the Fed pause, which is bullish, and later pulled forward kind of 3 rate cuts into 2024, but we also got the Yellen Yahtzee, which was lots of liquidity versus the opposite, which is more of what we had on that August 1st delivery. So November 1st, it definitely not only excited the bulls because they still had that backdrop of AI, but they had a lot of shorts to
Mm,
cover. 3 months of built up short. We're not in that situation now at all. We do not have a large amount of shorts that need to cover. We also have a very different backdrop. We're at 5,100, not 4,100. We have absolutely had reaccelerating inflation versus back then. The big change actually was November 14th, was after the November 1st Fed pause Yellen Yahtzee, where we had the CPI show that we had decelerating inflation, which was this beautiful deflation impulse that also got the Fed cuts pulled forward. So we had that kind of trifecta of monetary with liquidity
mm.
with short covering, and off we went to the races. This is obviously what propelled us higher, through December, January, and even in February, because I had, done a Bloomberg and a Market Watch thing going, you know what, I really see this market widening, broadening out. It's
Mhm.
not just going to be the NASDAQ 1999, or maybe 1995 if we really get some IPO excitement and such. But it looks like that the market's going to broaden out until March. March, everything petered out. It just started, retail started
Mhm.
falling off the cliff, and that call had to be pulled back. And then a lot of my intermarket analysis is very much focused on dollar, yields, breadth, volume, not just option flow, quants, and the rest. So March, I started to get really worried. And I'm like, you know what? My call for 53.40, which was my SPX call, bullish call for the year for 2024, I came close. But we didn't tag it. We started rolling over underneath the surface. There was net selling that was picking up. The breadth destruction was very clear, both in NASDAQ, not the leaders, but underneath the surface,
Mm-hmm.
and NYSE, which is a larger kind of way to, assess the market. So we basically had a lot of breadth breakdown and net selling underneath the surface that made me kind of pull that back and say, you know what? I think we need an equity correction. So we definitely had a string of outperformance, right, from that November 1st short covering rally right up until March 1st. And I mentioned March 1st because gold started spiking out higher. And I wrote on Twitter, thank you very much for the kind of succinct summary. I basically said, this is gold telling NASDAQ the crash up call is done.
Mm.
Use different words, but the point was they were going to have to slow down.
Mm-hmm.
And NASDAQ literally stopped going up on that day. And so March 1st, gold took off like hot fire flames. Silver followed later. We had a beautiful squeeze in late March. Now that was all, excitement because, China is hoarding gold, and they're basically, it's the new risk parity trade, long gold, short bonds. So by many estimations, and I'm very blessed that I work with two gentlemen who are macroeconomic wonks. I mean, they're just brilliant. And it was really this whole concept of the new risk parity is long gold, short bonds.
Mm.
So we had this very strong rotation into higher yields, higher dollar, and higher gold, gold being the tell that NASDAQ was not going to run higher at that moment. And we have obviously fulfilled that, right? We've gone sideways to lower in equities. And then after a 3-week pullback, and it was very, very strong, right? So on April 4th, we had our first 2% intraday drawdown in the SPY. It was negative 2.07%. Otherwise, we have not had a 2% pullback during regular trading hours for, oh goodness, 150 days more, right?
Yep.
So it has been bid. But I noticed following options that trifecta of selling puts, buying calls, and selling calls was petering out. So not only was the intermarket stuff saying dollar was going to spike, yields were going to spike, net selling was picking up underneath the surface, the breadth was breaking down, but the options market was also at risk. So it was good to kind of time that 3-month pullback, a 3-week pullback of late in April, at which point we're always going to have these reflexive bounces. And that's what we're in right now.
Mm.
So we've gone from, 415 in NASDAQ, QQQ to 430. I still see a gap above that's going to get filled, about, 445. So I can see 5,200 coming back into play for the S&P. But I really think that that's just an oversold bounce to kind of relieve that excitement of the reflexive bounce. And then I think we're going to set up for more continuation selling after that. That's my baseline bet right now. Short term, we're halfway in this bounce. Let's get to those levels, and then I think we're going to start hitting selling again.
And do you think the clearing kind of the FOMC, I mean, I think odds are generally betting that nothing big comes out of these FOMC events, and you get a little event vol crush. And is that kind of the fuel to lift things up? Do you think that 5,200 comes over days, weeks, sort of?
I think a lot is going to depend. Honestly, right now, the Treasury, the QRA, the composition is not known, but the amounts are known.
Mm-hmm.
There was a bit more for Q2, but there was a lot more issuance that's needed for Q3. That was a big surprise. So it always comes down to the composition. We'll know that 8:30 tomorrow morning. And then, of course, the Fed does its announcement, and it's not expected to hike or cut. In fact, it's very, very slim pickings for a cut when there isn't consensus on the committee and when there is obviously reaccelerating inflation. I think right now the market kind of knows that. So eyes are now off the prize of, we know what Treasury, for the most part, not necessarily how many, the composition of the bills or bonds. That's definitely a concern, not just for, between now and July, but especially in July. But we've already kind of assumed that Yellen is political, that monetary dominance has shifted to fiscal dominance. There's definitely a politicizing of the Fed and Treasury in an election year. So I think because the cuts have been pulled back out, right, because of this very sticky inflation, wage inflation was reported this morning, and it's definitely outpacing productivity. Bonds hate that, by the way. Yields are a real risk for moving higher. So it is more than just, the yen carry trade unwind or just the composition of how Yellen's going to, finance the fiscal spending, or the excruciatingly painful increase in fiscal deficits that have now interest rates that are really going parabolic. It is the fact that that Fed cut expectation has been pulled out.
Mm-hmm.
And now bulls are betting that we're going to have a really strong earnings season after season after season. In other words, the expectations are going to be that because of all this fiscal spending, we're going to have continued economic growth. We're going to have continued earnings delight. But the disconnect is where they think the Treasury financing of this, fiscal spending, and also this fiscal spending, is going to somehow lower yield. And that's where I think they're dead wrong. So I really have a backdrop that before, right, after that November, December, January timeframe, where it looked like the market was expanding underneath the surface, and then everything stopped at the end of February and into March, gold shot higher. The breakdown started happening underneath the surface. Yields started percolating higher again to that 4.7. That's it. All bets are off. Now, I'm stalking a market top where we have this disappointment, because the whole bull thesis is based on earnings reflecting economic growth, while Treasury and fiscal liquidity is somehow going to force yields lower. That's the disconnect. I mean, just that's the disconnect.
Yeah.
So for me, I see that we're going to have some disappointment as it relates to yields moving much stronger, which is going to put the bulls on the ropes as it relates to their main thesis that earnings have troughed and are moving higher.
The earnings part is extremely interesting because, as you mentioned, markets have been handling the reduction of the rate cuts, right? Like we were pricing in 6, now we have none. Who knows what's going to come? But S&P is only 2-3% off of all-time highs.
Yeah.
And one of the things I found was interesting, as you mentioned before, it was sort of like, look, semis and AI is going to save the world. That was the trade that we could all latch onto. And earnings kind of mixed so far. I was just looking at Microsoft, actually, which had a nice pop, I think 6% after earnings. It's now down below 400. Google's still holding on. We get Amazon tonight, Apple, obviously, AMD, SMCI. So I think that earnings as a catalyst narrative, we can really start to pull a lot of that information out today with today's numbers, and then obviously people are hanging on that Apple, hanging on Apple in a couple of days as well. So I do take your point that if we don't have great earnings or some sort of real catalyst here, then what as a bull do you start to latch onto?
Yeah, basically fiscal stimulus that is an economic growth engine, but it has diminishing rate of return because all the interest payments are still a big nut to crack. And basically, we're going to have continued rising term premium and interest rates until they can get control, which means they stop spending. So we'll, for the most part, kind of have to look at earnings from a different standpoint as well than typical, which is right now, the cash, right, that would be very, very instrumental to stock buybacks on the balance sheets of a lot of earning companies is now being transitioned to CAPEX. So this is really actually another little headwind. We'll have to see how that plays out over time. But in the past, it was a destructive use of capital to speculate. Now we actually have to get our act together as it relates to competing on the global stage. And we're really going to have to invest a lot more in everything. So issuing, Amazon leaked that they're going to issue some dividends might not be such a bullish backdrop given all the spending on capex that they have coming down the pike. But earnings aside, the bulls are really, really expecting. What are they expecting right here? 20% EPS acceleration between Q1 and Q4 this year. So that's based on really strong economic growth. And I have, my intermarket tell says, that's going to be really tough. And my ratio analysis says, wait a minute, we're really actually lower than we were in November 2021 when we had all that, QE extravaganza bid up earnings and stocks. So I think we actually have a good test coming with this kind of, I don't want to call it liquidity air pocket, but you can see Bitcoin's losing momentum. You can see since March, NASDAQ has been losing momentum. The Mag 7 has actually started to lose momentum, but the breadth underneath the surface hasn't picked up as we need for this continuation bull market.
And as we talk here, Bitcoin just above the 60,000 levels. That's
I'm short Bitcoin, long China. So that's a thesis right now. As well as I still think silver miners are going to do well. Even though gold and silver right now are digesting while yields are moving higher, which was actually a baseline thesis a few weeks ago. So we were really in that trade early. So liking miners, definitely liking China over NASDAQ right now, and not Bitcoin because it's too much of a speculative asset when it comes to higher yield. So if my whole baseline bet, long story short, is that I see higher yields, and I've placed this in a year in advance, right? So a year prior to October of 2023, I said I see 4.7. We hit 4.7. We actually overshot to 5, right? Before we actually got a lot of intervention on that November 1st time frame in 2023. But same thing, expecting a pullback into that 4% area, and then I see it going up to 5.3 for the 10-year. Once we get above 5.3 on that 10-year, we're going to be very quickly accelerating to 6.5%. So every year I give like my next, as far as interest rate targets, and so far they have been really spot on year after year after year. So I am still very much an inflationista, for lack of a better term, and a rate bull. And that, I think, is going to start to challenge some of these earnings assumptions, which right now haven't been challenged because they have been beating, obviously, on a low bar relative to 2023. But they also have had a backdrop of still plenty of, Fed put, Treasury put, and that might change as we get closer to the election. And we definitely have some risks that the intervention tricks are failing. They have a diminishing rate of return.
Right.
I think we're going to definitely get tested this year.
Yeah, I agree with you on that. That things seem to be sniffing out. That just statements don't have the same impact that they used to. I think you could kind of jawbone assets around, but people are starting to sniff things out. And on the earnings front, I just think that this market still very much hangs on NVIDIA. And so I think that people will be willing to look past a fair amount of, neutrality in earnings growth. If NVIDIA comes along to look at the AI story is super strong, and we made another, whatever it is, $500 billion in the quarter or something. And that may invigorate things. But at the same time, if you do look back at mid-March, it was NVIDIA earnings and then the NVIDIA GTC conference that really smashed semi-skews, and that really stopped the ball from rolling forward. And it's hard to regain that momentum, particularly with the macro backdrop that you outlined. Now, if we do get the 10-year or yields moving up as much as you said, I mean, what does that do for equities? I would have to imagine that you would view equities as having to be material lower, but correct me if I'm wrong there.
Oh, no, 100%. I mean, unless they come in with some, intervention, which is always what I look for, right? When yields get too hot, I am fully expecting the intervention. And we had that, spot on when term premium spiked, the 10-year went to 5%. And then lo and behold, Yellen came in on November 1st and really said, no, we're going to issue lots and lots via bills. And Make in Japan also came in and did their intervention. So that kind of coordinated effort wasn't the same energy as October of 2022. October of 2022, we were in trouble. The gilts had blown out. Bank of Japan did its first, major yen intervention in 24 years, and basically the 10-year was spiking at 4.33. That was the level that was causing equity disturbance. And so a central bank global coordinated effort. Matt King from Citibank said it equated to about 1.5 trillion. That is what I mean by intervention. We got it in October of 2022. We got it again, a bank backstop in March of 2023. We got it again November 1st of 2023 with the Fed pause and Yellen Yahtzee. So those are events where it is absolutely not productive to short. When we get into these higher levels where bulls are very long, quants are very long, CTAs and such, we don't have high levels of short. We have to look for a top margin debt to cash ratio. Again, breadth breakdown. And of course, everything that happens underneath the surface with the Treasury market and why gold is moving strongly higher, which is, of course, risk off as it relates to U.S. Treasury holders, as well as dollar holders. Even though dollar has moved higher, it's in large part very strong to competing currencies that are devaluating in a competition to support the local economy. But it's very, very weak relative to hard assets. So, parsing some of that stuff out is part of the job of looking macro to micro to then find when we're going to have some good selling under the surface and the breadth breakdown, which we had really strongly during March, and then it fell apart for a few weeks in April, and now we're having a reflexive bounce. So after this bounce exhausts itself, I think in that 5,200, 445 area, we can short again.
Yeah, I'm with you on the reflexive bounce. I mean, to your points before, there was a lot of just oversold indicators, put levels, and put to call ratios and different things like that. I want to ask you about the yen, which has been moving a lot. I know that's something that you covered. We're currently at 157.6. We touched 160 before things kind of reversed rather violently with the intervention. This is not a space I cover, but I definitely want to get your views on it, as I know a lot of people are talking about that. What can we take away from this? What's happened over the last couple of days? Got any insights for us there?
Yeah, I think Japan, by the way, is liking this yen drop or devaluation, because the companies that benefit the most are the 5 largest trading houses, for example, of Japan that deal in commodities. The tourism business also really likes it. It's a way to compete with China. And it's a way to basically handle the higher yield that we have right now in the U.S. and the dollar strength. So I would say that they're okay with it. In other words, the yen falling and the intervention that happened on a Sunday night in thin liquidity markets on an evening of a Japanese holiday isn't really yen intervention. So and you can kind of notice that it didn't last very long. 160, 155, it bounced right back up to 157. So it's really not going to stick. It feels like they could do another one tonight, by the way, but they need some help. It isn't just enough for them to intervene. They really are not going to, I'm going to say this the wrong way, but I mean, they're really not going to get the job done unless it's coordinated with the U.S. So, and that's all there is to say about that. It really has right now a very, very strong chart read until much higher. So anything above 152, where they promised repeatedly to come in and tap it down. They did it in October again of 2022 and October of 2023. Now that is solid support for a much higher move. So the intervention has also diminishing rate of return, and the impact of that is a slow unwind of the yen carry trade, which is very, very supportive to higher interest rates here in the U.S. So that yield differential is between their 30-year, our 30-year, our 10-year, their 10-year is very predictable. So you can kind of, from an intraday or day or week time, doesn't matter. You can see the correlation is so strong with our 10-year yield. So I would say this is, for right now, short-term beneficial for them, for the reasons I just talked about it, right? Their commodity houses are making lots of money, of which Buffett is
I
a
was going to say that's the Buffett
8.6%
trade. Yeah.
owner. He's trying to bring it to 10%, and Elliott took a stake in one of them. They're benefiting from higher from this whole inflationary move of and deflation of the devaluation of the currency and inflation backdrop. They're printing money, but it will get to a point where it starts to unwind, and that will be very supportive of higher U.S. yields. So that's the risk, but it's a slow, then all at once kind of thing. It's very tough to time.
Those are really interesting insights, particularly linking those to the carry trades. As we got about 5 minutes left here, one of the things we've been asking our guests is kind of the one thing question. If you wanted to highlight one signal, one indicator, one idea for traders to look at, could be investment linked, or maybe even something slightly outside of investment arena. What's one thing you could flag for us and say, hey, everyone, pay attention to this over the next couple of days, as this will really kind of be a nice signal to kind of guide us over the next couple of weeks, let's say.
Goodness, I have, so I do this intermarket analysis, which is really cross asset comparison, contrast, to see where there are divergences or, strength, weakness, and sector rotation. Also volatility, when we're getting to a point where it's definitely looking very robust for a shakeout, up or down, by the way, because that's kind of the thing, right? You want to, for me anyway, I want to time sector rotation. Money is always flowing from one sector to another, banks to, to tech, or growth to value. The point is, it's in lieu of sector rotation, there will be volatility. So when I start to see that there's no leadership, then that's the worry point. And then I know that the next level that's going to get hit out of sector rotation comes volatility. So right now, I have a growth value rotation ratio that I follow. I have a dollar yield ratio that I follow. And those are my two kind of go-to indicators that help me time and position for clients that energy, if you will. And I would say the biggest threat that I have right now is that dollar yield indicator that is moving higher and it's in danger territory. So that particular indicator is basically flashing that it's not done going up. And that is one of my reasons for being strongly bullish the 10-year yield, bearish bonds. And I'm not talking about this week or next week. I'm talking about, for the next few months. And that was a surprise to me because I actually didn't think we were going to get this higher 10-year yield until Q4 or Q5. It was pulled when I made that call last October. Okay. I really didn't think we were going to get this until the end of the year, toward the election. We got it way early. So that just, to me, it is a sign of how fragile the market is with all the other indicators. But that dollar yield one is percolating very strongly, and that says caution. That's my biggest tell right now.
Wow, those are some extremely interesting and unique insights. I learned a lot, and can't thank you enough for joining us. If people want to find out more from you, where can they reach you?
Website is LaDucTrading.com, LADUC. Samantha LaDuc at Twitter, as well as Substack. I just launched a Substack recently. So
okay.
I've got those kind of three main points, and I'm not alone. I have a trading desk of 10. I have two hedge fund managers, Craig Shapiro and Jeffrey Fouvray, who are brilliant. One is a kind of a modern day hedge fund manager. The other is a classical economist. And then that's for our edge product. And then I have a club product, which is very much for kind of intermediate level savvy traders and investors, more active. And I run a chase, a swing, and a trend portfolio. And we go over all of this stuff in the live trading room. So I have a whole bunch of excellent contributors. And it's a lot of fun working together and collaborating and finding things that I would never find on my own and asking questions, with a different perspective and getting that tested all the time.
Right.
So it's very profitable.
Takes a team, as they say.
It does. At least I like working in a team.
Yeah.
There's no question about it. We're
Yeah.
doing good work for clients, and you can find me there.
That's awesome. Thanks so much. And if you enjoyed our conversation with Samantha and some of the other conversations we had today, please head over to youtube.com/SpotGamma. There is a donate button there, and that will allow you to donate to the Susan G. Komen Breast Cancer Foundation, which is a wonderful charity that we're working with here. Hopefully trying to do some good, as the P&L for Purpose title suggests, as we look to raise funds for charity. Again, they do that in association with Simplify ETFs. You can also look up the Pink ETF, and proceeds from that Pink ETF, or fees, I should say, do go to the Susan G. Komen Foundation as well. Next up here, we have Wes Gray, the Alpha Architect. And Samantha, I don't know if you've ever seen the Box ETF. It's one of my favorite ETFs.
I really thank you for doing this, Brent. Excellent cause, and I appreciate the invite.
Yeah, absolutely. Anytime, and I look forward to speaking to you again soon, Samantha.
Cheers. Bye.